In this module, we continue our discussion about performance evaluation and extend the idea of budgetary control to a concept that's called responsibility accounting. Now, we're going to define what a responsibility accounting is all about. Who has the authority to make the day-to-day decisions about costs? And the conditions are that these costs and revenues can be directly associated with a level of management responsibility, and that manager has control over those costs and revenues. And so therefore, in a company, all levels of responsibility are involved. If you're a department manager, then you're responsible for the cost in that department. If you're a division manager, then you are responsible for the costs in your division, which may include 2 or more departments. And of course, if you're the head cheese, you're responsible for all the costs in a company. Now, a responsibility center is what we're talking about, and that is any manager who has control and is accountable for the activities that he controls. And of course, at every level of management, we have this situation, especially in a decentralized company, where the control of operations is delegated to many managers throughout the organization. And the segment is the area of responsibility for which these responsibility accounting reports are presented. Now, there are 2 differences from budgeting and reporting costs and revenue. First of all, here, with the costs, we have to distinguish between those costs that are controllable by the manager and those costs that are not controllable. And therefore, the report should only include those items that are controllable by the individual manager. And this applies to just not profit companies, but non-profit companies. Now, a critical issue is whether that cost or revenue, but mostly cost, is controllable at the level of responsibility with which it is associated. A cost over which a manager has control is obviously called a controllable cost. Now, if you're the top manager of a company, you are responsible for all costs, and it is assumed that you have control over those costs. Fewer costs are controllable as you move down the organization chart to the department level. Now, costs incurred indirectly, and that is allocated by the accountant to your division or your area of responsibility, are non-controllable costs. Now, a couple of principles with regards to performance evaluation. Management functions that we're going to evaluate compare actual results with budgeted goals. Keep in mind, back in budget planning, the managers all participated in developing that budget. And so therefore, we're going to compare actual results in relation to that. Now, we don't focus, because we're dealing with issues in the future when you're budgeting, and now we're comparing actual results to what were forecasted. We focus on what is different. So management by exception is that kind of a concept. That means that top managements review a budget report and they focus on the difference between actual results and planned objectives. Now, there's going to be a difference. We can't predict right on what's going to happen. But the question is, how big is that difference? And that is the materiality concept. And that is basically, we don't focus on every difference. We set a standard that we will investigate only differences that are, say, 5% out on the estimates. And of course, we're only going to focus on those items in which there's a material difference on the items that the manager controls. And so that's management by exception. Managers of responsibility should have direct input into the process of establishing the budget goals. When we talked about participative budgeting in the past, the evaluation of performance should be based entirely on matters that are controllable by the manager that is being evaluated. Top management supports this evaluation process and allows managers to respond to their evaluation, and the evaluation identify good items of performance as well as poor. Okay. Now, some of the reporting principles when we come into performance evaluation. First of all, the report should contain only data controllable. We've talked about that. Provide accurate and reliable budget data to measure performance. And highlight significant differences between the actual results and the budget results. So the reporting system involves preparation of a report at each level of responsibility in the company's organizational chart. We begin at the department level, the lowest level, and we use the rule stick management by exception. That is, we are going to only focus on those items that are significantly variant from what we had planned. So as you can see on this, every manager is part of responsibility accounting. Now, it all feeds to different reports from the bottom up, from the department to the division to the vice president and to the president. Okay. Now, there are three types of cost centers. Three types of responsibility centers. The biggest part at the lowest level are called cost centers. Then we have profit centers and we have investment centers. Now, a cost center incurs only cost and does not generate revenue. The manager of that center has authority to incur those costs and therefore has control over those costs. Now, I want to use a university as an example. Think of the whole organization of a university. Who would be a manager of a cost center? Well, of course, HR. They generate the costs but not revenues, so they're a cost center. The same with IT department. They would be a cost center. Same with maintenance department. All these departments do not generate revenue. They only incur costs. They'd be a cost center. A profit center incurs costs but also generates revenue. And the manager is judged based on profit. We're going to match revenue against costs. And in a university, then you might look and you say, well, wait, the university has a number of different programs. There's business, there's engineering, there's arts and science. And each one of those programs generate revenue through tuition. Each one of them incurs costs. So you see, the manager, the dean of the business school, for example, would be judged based on the profit that the business school generates over the course of the years. So that manager is responsible for generating revenue and controlling costs. Now, an investment center, if we're looking at a manager of an investment center, if we're talking about a university situation, we have a main campus, and let's say we have a smaller campus in another town. Well, if we're going to judge the head of each of those campuses, you can see right away that the main campus would generate much more profit than the smaller campus. But then we relate that profit to the amount of investment in the assets that that manager controls. And then we turn that evaluation into a percentage. So an investment center incurs costs, generates revenue, and has control over the investment of funds. So therefore, the manager is evaluated on the profitability and the rate of return on the assets that that profitability earns. So we're talking return on assets. And those are the three. So responsibility accounting for a cost center is based on the manager's ability to meet budgeted goals for controlling costs. Responsibility Reports then simply compare the budget against the actual, as we've seen before, and the variance is highlighted as unfavorable or favorable. Now, the finishing department is able to control those costs from that report, you can see. Now, responsibility accounting for the profit center. The manager is judged on revenue and costs. But here, we have to distinguish the variable costs, obviously, but there are some fixed costs that are directly related and some that are indirectly related. So direct fixed costs relate specifically to one responsibility center. For example, IT, the cost of computing. But the rental costs or the overhead costs would be shared with other departments. So a direct cost is a cost that's incurred, a fixed cost that is incurred for the sole benefit of the responsibility center. An indirect cost has been allocated to that cost center. For example, we may charge the cost center occupancy cost at a rate of square footage. Well, okay, the occupancy cost then and that rate is an allocated rate. The responsibility report then should show the actual controllable revenue and controllable costs. And the type of format for this is the cost volume profit format. And here's an example. Marine division, you have sales, budgeted and actual. Then you have the variable costs, which would be controllable by the manager, and then only the controllable fixed cost. And once we subtract that, we have a new item here, which we use only for performance evaluation, and that item is called the controllable margin. So when we talk about a profit center, we're not talking basically profit as we understand it. We are talking about the controllable margin that that center has generated. Now, for an investment center, we take it one step further, and we compare that controllable margin to the assets that are associated with that investment center. And we come up with a return on investment. So we analyze the revenue minus the variable cost gives me the contribution margin minus the controllable fixed costs gives me the controllable margin. And that's what I use as quote unquote profit for an investment center. And I divide that by the average operating assets and I get an ROI. Now, the questions with regards to the operating assets, they should be only those assets that are used. If the investment center has an investment in some future development, they shouldn't be including that. All right. And we should be using the average assets. That is, we take it at the beginning of the year and the end of the year and divide by 2. And the responsibility report then for an investment center would show all of those with the controllable fixed costs. So here you go for an investment center. Again, sales minus the variable costs. That's fair enough. That's controllable by the manager. Minus those controllable fixed costs and other fixed costs. And we get a controllable margin, a $300,000 budget or $264 actual. So you can see that our profit is a little lower than we expected, so it's unfavorable. Nevertheless, we now know that the assets in the investment center are $2 million, so we relate the controllable margin to the operating assets of $2 million. And in budget, our goal was 15% return on investment. We achieved a 13.2. So there are a number of things to consider when you look at the ROI. For example, how do I define these operating assets? How do I evaluate them? Acquisition cost, book value, that's depreciation. So an older division responsibility center would have less book value in assets, appraised value, fair value. Those are all decisions that have to be made in light of the performance evaluation of the manager. And therefore, also, how do I measure income? Well, we're talking mostly about controllable margin, income from operations, or net income. And the decision is that only the controllable margin is a valid basis for evaluating a manager. Now, how, as a manager of an investment center, do you improve? Well, here's an example. You have the results, $2 million in sales, contribution margin, $900,000, controllable fixed costs, controllable margin, $600,000, operating assets, $5 million. So currently, I'm at 12%. So I can either increase my controllable margin or reduce my average operating assets. Those are the only two ways that I can improve on my ROI. So I can improve by the controllable margin by increasing my sales or getting, for example, a larger contribution margin, and also reducing assets. So increasing the controllable margin by increasing sales, reducing variable costs, improving on the contribution margin, and controlling the fixed costs. For example, if I increase sales by 10%, then sales from that past example would go up by $200,000. The controllable margin would increase by $90,000. And with that increase in controllable margin, even with the average assets being the same, I have achieved an increase in the ROI to 13.8. However, on the other hand, if I increase controllable margin by increasing sales and reducing variable, and decrease the variable and fixed costs, then I have a larger controllable margin, and with the same assets, $5 million, I've achieved a greater ROI. Thirdly, I could look at the average operating assets that I'm using, and in some way, if I'm able to reduce that, with my original controllable margin of 600, I again would increase my ROI. So those are methods that a manager who is responsible for an investment center would look at. Of course, if you're responsible for a profit center, you're looking at increasing your controllable margin as well. If you are a manager of a cost center, you are focusing on controlling costs as it relates to budget. And that concludes now our responsibility accounting centers.